Hello, everybody. Hi. Welcome to the All Street Beat, episode 5. Hope everyone's doing well today. Where I am, it's been raining for about 48 hours, so nature needed it, but it kind of gives a very um, indoor feel to life, I suppose. Hope everybody's doing well. We're getting quite a few people just tuning in right now, so. Let's just give it a couple of minutes before we start. I'm just gonna invite my co-host here, who's gonna help me get the panel up. Yeah, it's All Street Beat, as you know. This is brought to you by Commonwealth, and this is episode 5. Today, we're going to talk about circular and sustainable economies in Web3, specifically token economies. I think it's going to be super interesting. We've got a great panel. Kyle's going to come along and join us as well for a short period. Kyle, for those of you who don't know, this is like one of his absolute like dear to heart topics. Something he takes a lot of pride in, a lot of interest in, and has worn the scars of what it means to actually create token economies which are valuable and sustainable. Um, so this is great. We're getting quite a few people in here. Just while we're inviting up the panel, I'm just going to remind everybody about Commonwealth. Commonwealth is the host of the All Street Beat, and Commonwealth is a Web3 application and protocol, and it is designed to democratize and deconstruct the Web3 venture capital ecosystem. We've decided, or we've identified that the ecosystem for venture capital that is active in Web3 is not fit for purpose, essentially. Given that we have the technology at our fingertips in Web3 to do it better, Commonwealth is designing a protocol which allows for venture capital to happen on chain, and it allows for everybody, every single person who is interested to participate in that, to become an owner of the protocol, to become, as an investor, to become an owner of the fund as well. So any rewards that happen to the protocol because the fund is doing well actually go back to you as the owner of the protocol. So instead of a third party or a central entity taking those rewards, all those rewards go back into the ecosystem and are for the benefit of those who own the protocol and run the protocol and govern the protocol. Uh, we would like to say that we have some great tokenomics behind Commonwealth, a circular closed loop economic system, which has taken a long time to design, and in partnership with two very high level economic token economy specialists. And yeah, we're super pumped about the tokenomics for Commonwealth. I'm not gonna go under the hood just yet. I'm gonna leave that for Kyle to come in a second. But yeah, tokenomics is central to what Commonwealth is doing. It's a topic very, very dear to our hearts. It's why we believe that the wealth token, the token that will run the protocol, will be rare and highly valued or valuable, or something that people will want and need to hold. And we will unpack why that is. But we're not just looking at Commonwealth today. We're actually looking at, generally token economies. Web3 is essentially not new anymore. We're in the sort of the third, fourth, fifth cycle iterations of Web3. Throughout that time, we've seen lots of different types of economies come and go. Not that long ago, we had the gaming boom, which was, kind of led by Axie Infinity. And, Axie Infinity could have maintained its status as, one of the leading Web3 companies, one of the leading Web3 protocols, if the token economy was designed differently and wasn't so inflationary and didn't have so many leaks and points of failure. So I don't mean to single out just that one particular project. It's one that's on the top of my mind because my background is Web3 gaming. But essentially, it can make or break some of these, absolutely, beautiful applications, business models, things that are on chain, which otherwise could be, really, really fantastic. If you don't get the token economy right, you're going to really, really struggle. because ultimately crypto projects are viewed in terms of success on how well the token performs, and how well the token performs is a result of the tokenomics. So we're going to have a great discussion today. I can see already the panel is super full. So thanks, Utkarsha, for helping us get the panel here today, but also up on stage right now. Kyle, do you want to unmute and just say hi? How's it going over there? Where are you?
Hello. Yeah, just making some dinner. But I'm in Phuket here in Thailand, and yeah, I definitely wanted to join this one because I think it's a subject that's far often not talked about nearly enough, and people are blindly investing in these tokens that have no idea what they're doing, and then it's really important too. What I always try to stress about. In fact, I was on Mario's space last time I was a host there, and or speaker. I got in a huge argument with half the people, well, everyone on the panel, who was defending centralized Web2 projects that had a token for no reason. And I just think that it's important that people understand, what is the purpose of a token? Does the thing that you're investing in need a token? Is it decentralized or not? Um, and also what qualifies a really good token model, because you could argue that like sometimes
I've lost you, Kyle. I don't know if anybody else. Um, can one of the panel just unmute and just tell me if Kyle is also lost for you?
Yep, yes.
Okay. Okay. Thanks for confirming. I'll pick up from where Kyle was leaving off. Kyle, just check your internet connection on that side, or maybe something caught fire on the stove.
and that's
Great guys. I think
did I
you're
get
coming back in
cut
now.
out? Hello?
Yeah, you cut out. You're back in
Where
now.
did
Yeah.
where did I lose you? I had an incoming call. That's probably why.
Aha, okay. Well, I mean, if I just ask you the question, why do people find tokenomics so challenging? Can we start there?
Yeah, they don't I don't think necessarily challenging. I think that it's just overlooked. Uh, it's as a VC myself and all the due diligence I do on projects, you know, I just think we still have a really nascent and new space, and you have a lot of people who come who've been in the space since 2017, 2018, 2020, 21, 2022. And back in the day before 2017, you didn't in 2017 there was this huge ICO boom and everyone had dollar signs in their eyes and came into the space and didn't take the time to learn fundamentals of what's going on. A lot of people, if you still ask them, they look at crypto as like something that that you would see like the stock market, right? They look at cryptos like stocks and they come in to trade them, and they don't really understand. They think that this token automatically equates. Hear me?
Yeah, you just
Yeah,
cut
yeah.
out
It's
again.
what it's when I have a
I think
call
you're.
coming in that I
Yeah,
lose it. So people think that automatically a token equates to the success of a project, right? And so if you have like there's been a lot there's been a lot of times um when there has been some examples of projects that were centralized that had a token that they actually generated a lot of revenue, a lot of capital. And that capital went back into the founders' pockets in the form of like equity or cash, but it didn't, because it didn't have a properly designed token economic system, or the founders just didn't care or didn't learn it or pass that value back to the token holders. That token, was dropped down 99% and never came back. Um, and that's happens on a lot of things. There's a lot of cases right now that we could talk about. I think at some point in time I will maybe name names. I don't know if I'm prepared to do that today, but there was a gaming project that I invested into, like 2.5 years ago as the lead investor. And at the time, they didn't have their token ecosystem, figured out. It was a brand new project. They had built some of the platform, but it was going to be a gaming platform where you can go on, and they were supposed to have like a universal gaming token for a bunch of different games, and people can come play tournaments on this platform. And I asked them about the token early on, and that's what they were selling, was a SAF, selling a token to me as an investor. And I told them it's critical to figure out the token economics. And I knew that it was a long way before they would launch. And so we agreed that we would invest, but that they would consult us in the future to make sure that the value accrual was going to the right place, and that that our investment was well taken care of and honored, because I was investing in I was under the impression I was investing in a decentralized protocol, where the token would be how all the value was accrued. And then about 4 months ago, this is so 2 years after I invested $200,000, we got on a call. They wanted to run me through their pitch deck again and the updates, and we go through it. And I ask at the end of the pitch, it's a great pitch for something, and the founders seem to be pretty smart yet ignorant and naive. And so they go through the pitch, and I ask again. I say, okay, well, you're preparing for TGE, in a pretty soon, and I still don't understand how the value accrual happens or what the point of this token is. And they told me that you could spend it to buy things on the platform. And whenever someone says that, you have to ask, well, can't you just use Ethereum or USDT or whatever? There's a million, there's a bunch of different alternative cryptocurrencies now that are strictly currencies. And so if someone says you use it to pay for something, it's a really, really, really bad use case. We don't need another currency. We've got Bitcoin. We've got, Ethereum is used as a currency often, stable coins. Stable coins on very cheap networks with almost no fees. If Tron is like no fees. So you don't need this. And so I started talking to him. I said, guys, well, now it seems like you guys sold all of your investors, which you raised $10 million. You sold all of your investors a token that has no freaking use case, and you're about to launch. And the entire pitch you just gave me about your product, all of the value accrual, all the fees, everything goes back to the company. And who owns the company? You two founders own the company. You didn't sell any equity. Our investments don't count for equity. And as far as I'm concerned, this is a useless token with no utility. And and all they said was, oh, well, Horizon Labs is now going to help us with the token economics. I'm like, well, Horizon Lab, and they were super cocky because Horizon Labs working with Yuga Labs and Bored Ape Yacht Club. And I said Bored Ape Yacht Club and Yuga Labs didn't bring them on for token economics. They brought them on because they do really cool like metaverse stuff. So this doesn't make any sense to me. They're like, oh no, it's their investment in token division. I was like, okay, I want to talk to them. And then they never, because I was really mad. And I told, and they didn't understand this, right? And so on the call, I started saying, you guys are ignorantly committing fraud. You've pitched this presentation that, this to all of your investors about this really cool product that has real revenue generation, but none of it goes to the token holders. And this is what you've sold the vision as. And so I think it's also really important to be clear for people when they are pitching a project or investing in a project to understand, where the revenue flows. And if you're being asked to invest in a token, like make sure that the value accrual is in the token, and hopefully it's only in the token and not equity to founders. And this is when Tim says closed loop circular token economy, the closed loop is the most interesting part of that, because if you don't have a closed loop, you might have some degree of a token economy that's decent. So you might have some value accrual that goes to the token, but oftentimes if it's not closed loop, a lot of that value flows back to the founders and siphoned out or extracted back out of the ecosystem. And so so I kind of call these like non-closed loop token economies like web. Maybe you could say it's like a web 2.5. It's partially quote unquote decentralized or partially has a decent token economy. But the danger of that is, let's say that someone created an amazing decentralized version of Uber, and I think Uber takes 30% of the revenue. But then someone comes along and says, okay, we're making a decentralized version of Uber, and it's better because we only take 15%, and so the drivers make more money, and passengers pay less money. So we're disrupting Uber. Well, that's great, but you're still taking $15 out of every $100 ride, and there's a savings of $15. It's better than Uber, yes, but if you can create a closed loop circular token economy, 99% of the value stays with the ecosystem, which means that the driver and passenger both get better opportunities. and you have that $1 that goes back to securing the network or for some other purpose. And so it's ultimately a more efficient model that will create, maybe disrupt that thing that did disrupt Uber in the first place, because it's a better economic model. And when you have the same user experience, the same UX UI, people are going to choose the option that's more economical, either makes them more money or they have to pay less to use the service every single time, so long as the user experience and the convenience is the same. So these are really important things to understand for people who want to build sustainable, amazing, disruptive projects that have longevity. So, this is one of the most important topics. Commonwealth, we spent, not every day with the whole team nonstop, over a year, but we did spend over a year building out the token economy, going over everything and figuring out how everything works. And I can say with confidence, and of course people could say that I'm biased, but it is true. Commonwealth has undeniably the best token economy that I've seen in any project, hands down by far. And the way that it incorporates NFTs into the entire picture as well is incredibly interesting. So to where I could even say that maybe it gives the best use case for NFTs I've ever seen in any project as well. And so not only does Commonwealth have an awesome disruptive use case that really solves a real problem, democratizing and lowering the barrier of entry for anybody to get into the best deals in the space, but it also has a truly decentralized model, is closed loop circular token economy, and really going after the 99%. So we have this whole Wall Street bets, Occupy Wall Street kind of mentality where the power of the crowd is massive. And so this project, Commonwealth, has been thought about in depth for a very long time, taken very seriously. And we wanted to build something, that was the best of the best, not from I don't know, from a meme perspective, but from a virality perspective, from a making money perspective, an economic perspective, a token perspective, an NFT perspective. And so, yeah, I think that I've said quite a bit. You're free to ask any more questions or chip in, or anyone else that's listening also feel free to ask questions. And if any of the speakers have anything to add, please feel free. And if anybody thinks that I'm out of my mind and wants to challenge anything I said, I'm also open to that. I love good, healthy debates. And so if you think that centralized blockchain is awesome and that tokens belong in a centralized blockchain somehow, feel free to step up on stage and have a discussion about that as well.
Thanks, Kyle. That was a really, really great overview. Thank you. If you do have to leave us to go back to your dinner, then thanks very much. But otherwise, just stick around because there's going to be quite a lot of exchanges between the panelists here. I do have a speakers list in terms of who I'm going to go to next. So I'm going to invite the next speaker up in just one second. But Kyle covered a lot of stuff there. He talked about red flags he would look at whenever it comes. He even went deep into an example here, which I thought was super interesting. We won't ask you to name and shame, but there is an upcoming All Street Beat in a couple of weeks, guys, where we are going to talk about like epic investment fails, where we're going to talk about like horror stories that we've experienced as investors. And this could be a time actually to go into something like that, Kyle.
Tim, real quick, I'm
yeah.
gonna I have to make a call real quick, and then I'll dial back in. So I'll be back in 5 minutes or so.
Yeah, sure, no problem. Thanks.
Okay, cheers.
And a lot of other things Kyle said. There's the pseudo kind of Web 2.5 where you don't go all the way to be fully closed loop, and some of the value extracted out of the economy, some stays in the economy. There's a lot of stuff, a lot of touch points here to get the conversation going. Just before we move to the next speaker, everybody who's here, thank you for joining. If you don't mind, just send out a tweet to your communities or your friends and just say, hey, listening to this like super interesting high level discussion on token economies, come join me. And that goes for the panel too. If you wouldn't mind, let's get as many people in here as possible so that we can really share the insights, high level insights with everyone. So John, I'm going to go to you. Kyle's kicked us off nicely. What do you have to add?
Well, first, thanks for having me. I guess like an introduction is in order because probably it's the first time that most of the people in the room are seeing me. So my name is John Cho. I am the Vice President of Marketing at Clayton. And if you're not familiar with Clayton, we are a layer 1 blockchain. And so in terms of presence and coverage, we are focused on the Asian region. So we're probably one of the most used chains in East Asia and the Southeast Asian region. Our genesis happened back in 2019. I've been with Clayton since 2019 as well myself. And we have a pretty unique start compared to the other projects out there. So we were established by a corporation. So we do come from the legacy industry, a corporation called Kakao. I don't know if anybody is familiar with Kakao, but Kakao is probably one of the biggest technology companies in South Korea, both from a user-based perspective and from a market capitalization perspective. So Kakao is known for its Kakao Messenger, which is basically the WeChat of South Korea. We have a market share of 94%. So we do come from a traditional legacy vertical. Just like a brief overview, Kakao, the Kakao Corporation decided to establish its own blockchain to kind of overcome, the restrictions and the bottlenecks that traditional kind of like closed networks are presented in terms of like expanding and onboarding new users. So it decided to create its own blockchain. That was a Clayton, and so we've been around since 2019. So we are a pretty big ecosystem. We have around 300 plus dApps live on the Clayton chain right now. Average daily transactions, last time I checked, was around 540,000 daily transactions. It was our fourth anniversary just the other day. So was going through the data, and looks like we've accumulated up to 1.6 billion transactions. So yeah, we have a really vibrant, great chain, and I guess being involved with a layer 1 directly, I've had like a lot of discussions both internally and externally in regards to what makes a sustainable tokenomics model, right? And I think it's difficult, and that difficulty really came to fruition during 2021 and 2022. I think with all the P2E protocols out there, because I think people initially thought P2 was a great idea, being paid or earning be it passive income or like active income by doing something fun, playing a game. But I think as that aspect, the P2E aspect of Web3 gaming peaked, I think people realized that tokenomics is really vital in terms of survival, just from a protocol perspective. So yeah, tokenomics I think is critical and vital to the success of the industry and space overall. So for us, it's always been something that we've wanted to and are continuously exploring ways to optimize things, and it's difficult because there are so many perspectives and and kind of like differing and opposing perspectives that you need to find a balance for. Like at a very base level, tokenomics, especially for a layer 1 like us, is what makes the network incentives. So you have network incentives in place at a protocol level to facilitate network participation, to have our validators secure the network and so on. But at the same time, you also need to have aspects within the protocol and also within the tokenomics that create value for the token itself, as so we can create interest around the ecosystem. Because ultimately, we've seen with other L1s out there that the token price, like it or not, does play a massive role in terms of retail and end user interest in that particular ecosystem, and also interest from the developer community as well. So yeah, that balance between network incentives and also value creation for the token itself. And just to kickstart the conversation, and Kyle did a great job as well. So just to kind of put a few things out there, having spoken with a lot of teams, especially in the gaming sector, we found that, I think tokenomics itself, just having like a great, like a token model, like for example, it's super deflationary. You have a capped supply. Your FDV to circulating supply ratio is super low. The way you manage your treasury expenditure is super transparent. And that's all fine. That's great. And all that stuff contributes to a great tokenomics model. But at the end of the day, I think one of the kind of like core takeaways for us, again, having spoken to a ton of teams over the last year and a half, was in order for a token to create value for itself, to be sustainable, to maintain a certain level of value in relation to the rest of the market, is you need a great real world revenue model in conjunction with your tokenomics, because I think you can have, again, like I mentioned, all those things, deflationary models, cap supply and all that stuff. But at the end of the day, if your team's operation is dependent on converting your native tokens into fiat, as so you can actually pay your employees, it just becomes a vicious cycle, right? So a real working revenue model we found is super important in terms of maintaining and facilitating a sustainable tokenomics model. And of course, that revenue stream would have to be be it another token or be it in fiat, but something besides your native token. Because again, if you're constantly sending your share of from a team's perspective, your share of your native tokens to an off ramp in order to kind of finance your operations, it just becomes a vicious cycle. So that's something that we found, just having a solid, real world, working, tangible revenue model in conjunction with your tokenomics. So just wanted to put that out there.
John, that was great. Thanks very much. I just want to ask you, can you give an example very quickly, because I want to move to the next speaker as well. But in your case, what was that revenue, just to make it less abstract?
Yeah. So the thing is, the reason why we were able to come to this conclusion and have this kind of lessons learned is that, especially within the Web3 dApp space, be it gaming, be it an NFT oriented protocol, they still haven't found that kind of real world tangible revenue stream or business model. The protocols that the teams that do tend to have a tangible and functioning and sustainable business model, revenue model, tend to be in the DeFi space. So things like commission from swaps and and stuff like that. So that at the moment, for now, a lot of the more tangible revenue streams tend to happen in the DeFi space. Have not actually really kind of seen specific examples in the gaming space that merits study, to be honest. So yeah. It's something that's work in progress, I think.
Yeah. Okay.
John,
Cool. Thanks so much, John. We'll try to circle back to you.
Tim,
Go ahead.
I'm gonna jump in. Yeah. So John, that was quite good. Thank you. I wanted to say a couple things. I'll get to an example of the revenue model, and I think just add one more thing that I'm curious if John, what his stance is on this, but tokens are really interesting too. Like a lot of if Gensler was on this call right now, he would be just immediately writing John a Wells notice, because and John, I'm saying this, I'll love it, because we're in the same boat, and actually all token economics really violate the essence of what the Howey test is, right? Like token economics were designed in a way that's are supposed to accrue value and appreciate in time. They are the economic incentives in an ecosystem, a DAO, a protocol, whatever, that are supposed to incentivize early adopters, people who are there to do a lot of the work and help the thing get off the ground remember in the early days, people were mining Bitcoin when it didn't even have value at all. And then when it did have value, it was worth 10,000 Bitcoin for 2 Papa John pizzas, right? So like, and imagine all the people who were buying hardware and spending money on electricity every single month to maintain the network when there was no value. But their hopes and dreams were that it would appreciate one day. And so it's the same thing with tokens for altcoins, is that people get in early. They hope that the thing will appreciate in value. And also when you raise money for a token, of course, there's expectations of returns because they believe in what the vision is from the founders. And they say that this thing has a really good token model, it has really good utility. We believe that it's going to generate value. And so I just wanted to throw that out there. It's very interesting. It's been a very frustrating point, I think, for a lot of us in the industry who really understand token economics, and to hear the kind of things that come out of regulators that don't understand it clearly. And just one more thing I wanted to say about the revenue model is it's really interesting too. And we need to start thinking about how we define, if a project does have a revenue model that is billed or earned in some other token other than its native token. So in Commonwealth, for example, it's wealth, and in Commonwealth, the protocol generates revenue from the management fees from the funds, right? And so that is charged in stablecoin, which goes back to the treasury. Now, the wealth DAO will always be very transparent, and everything's on chain. Of course, it's stablecoin. That's what's really nice as well, is you don't have cash generation and fiat. You have stablecoin generation through smart contracts that is trackable on chain, and the treasury will always be transparent. And the DAO will publish reports about what the runway is, what the burn rate is. And I know that when we've talked in meetings, and this, don't hold this to this as gospel, but I think we've agreed that we'd like to have 4 years of runway in the treasury at all times. After that, if the treasury is still generating excess revenue, we would like to then think and ask the DAO to open it up. How should this excess revenue be reallocated? Because that's the one thing too that worries me about other revenue generation, because you can take that excess revenue and founders can either put it in their pockets and just pretend like nothing happened, or they can think about how do we distribute that throughout the ecosystem and create more value. And that, again, goes back to a closed loop token ecosystem. And why do we create value in another token other than the wealth token? Because that way we don't need to spend the wealth token to fund operations continuously, which puts downward sell pressure constantly from treasuries into the token. And so this is a really interesting model. I love it. But it also leaves us to the question of, what do we do in the treasury with all these excess tokens, right? Typically a team and advisors usually get 20% of tokens supplied. Then you've got, you're selling 20 to 30% to investors and in public sale. And then you have all these other tokens that are sitting there in like reserve, ecosystem development. And yeah, some of them could be used for partnerships and ecosystem, but also there's a huge amount typically on these token allocations for reserves and ecosystem development. And if you do have a revenue model that's generating revenue that's sufficient, then you don't need all these tokens to sell. And so I guess what we're doing for Paid Network is we're looking and saying, do we actually need these tokens? If not, like I think John was saying, the goal should be to get to as close to fully diluted valuation as possible to give confidence to investors and secondary market that there's not a whole lot of inflation and dilution in the future. And that's a really good sign to secondary market participants that they want to see that circulating market cap as close to fully diluted as possible. Tim, I'll pass it back to you so you can pass it to whoever's next.
Thanks. Thanks very much, Carl.
If you're okay with it,
yeah, John.
Yeah, just respond. I mean, Carl made a couple of great points there, and I just wanted to highlight and reiterate a few things. So, just his last point in terms of FDV to circulating supply. So I don't know if the people in the room are aware, but there has been a movement here, at least domestically in South Korea, where you're seeing a lot of Web3 communities kind of interface with, and interact with, project teams, asking them to kind of provide rationale for the reserves. And a lot of the time, a reserve is just that, it's a reserve. So a lot of the time we find that teams don't really have specific kind of roadmaps in place for the utilization of that reserve, which, in return creates a lot of concern for secondary market participants, for retail participants, right? So there's this movement that's been happening in domestically in Korea called zero reserve. And we're seeing what happened is we're seeing a lot of be it like an L1 project or be it just like a DApp team actually being proactive and burning their reserves in the case that they don't have specific kind of like roadmaps or utilization strategies for that reserve. So what we did at Clayton was we actually burned I think 50% of, we committed to burning our entire reserve, uncirculating reserve, and we actually recently burned 50% of our uncirculating reserve. And the reason why we just came to that decision, and it was after a lot of debate, was, at the end of the day, the reserve was generated during the initial token generation event at Genesis. So it wasn't something that was a part of the annual inflation via block rewards, right? So it was something that was always there. But at the end of the day, we were just being honest with ourselves. So we had high level utilization roadmaps in place, but those high level plans weren't something that we were really kind of like committed to, or was sure that, that would kind of contribute to the success of the ecosystem overall. So we decided at the end, at the end of the day, a successful tokenomics, it's basically, more demand than supply, right? So to create kind of like, demand in order to facilitate value creation.
John,
Sorry.
I'm going to have to, sorry, because we've got like 10 more speakers to get through, and I'm just a bit concerned. But what you're saying is gold, and what Kyle said was gold. It's, like managing the supply is huge, right? Because that's the big fear, and that's, that's where a lot of people who are assessing a token economy, that's the first thing they will look to. What's going to be the sell pressure, and what's going to drive the value of my token. And if there is, these reserves sitting there from TGE, for example, I think you guys are onto something. I think you're talking about, you're definitely on the right thread. So thank you for that. Thanks for launching the discussion. I'm going to ask Siddharth to come in and just say who you are, why you're here, and also tell us what you're thinking so far and what you want to add to this discussion.
Sure, thanks. And I think it's a great discussion, really good level-head folks talking about really good sense, right? Like probably 3-4 years back, you would hear very random things about using token as a currency, and very soon you'll understand the flaws of that. Well, I'm Siddharth. In 2017, I co-founded an exchange called as WazirX. WazirX is based out of India. This is during the banking ban in India. So I don't know if many people know that there was something called as banking ban, where exchanges cannot have a bank account for holding users' custody. But nevertheless, we innovated, I built something called as P2P, auto order matching P2P exchange, which is world's first, and with which we were able to build liquidity for on-ramp and off-ramp. And within a year's time, we became number one. And, within 3-4 years, we were doing almost 60 billion in volume. Later, we got acquired by Binance. So it wasn't a massive, success in terms of, bringing crypto to India, especially with those circumstances that we were building. And fast forward, I was also very interested in games in general. And I was investing in games in 2018. I was investing in 19. And back then, it felt very, very, natural for games to have tokens and have assets and, and simply adopt crypto. But that was not the case, right? Like I started losing money, and I was like, hey, what's happening, right? This seems like a very good use case, and still you're losing money. And that's when I started going deeper into all my investments. And that's how I started exploring the whole secondary market problem. So in WazirX, we were trying to solve the same secondary market problem by creating liquidity for on-ramp and off-ramp. If you are not into a market problem, creating liquidity is one of the toughest problems, right? Like it's so just because you have Bitcoin, USDT, it's one pair. But if you want to create Bitcoin, say INR or any other fiat, it's a new market itself, and you have to create both sides, bid and ask. And it's very difficult to create that. And there were certain things that we learned. And when I saw these games, the way they operated, if you were to buy an asset, you had every asset was very different. So it was obviously an NFT marketplace. Back then, NFT was not a big thing, right? The term was not coined then, or it was just early days of coining it. And I saw that it's impossible for somebody to easily buy something in bulk and also sell something in bulk, because he has to pick and choose. Should I buy a cow with 100% health, or 20%, 40%? And there's all these decisions that a user has to do just to deploy $100. So if he can't deploy $100, how can he even take out $100 out, right? So I saw that friction and I said, hey, this is not going to work, right? This is definitely not something that will scale. And that's when I started going more deeper with games. Back then, I did not have an intention to start, Tegro, which I later started, which is solving the secondary market problem. So I started working with this game. I said, hey guys, let's move this NFT part. Let's make it a little more fungible. Let's make a very good order book based marketplace. And the day we did that, it took us some time. The market started reacting better. We were able to create liquidity. We were able to bring in market makers, get them secondary market, and healthy secondary market is actually a healthy project, right? At the end, it's very important, right? It doesn't matter, Malibu or different beautiful places look beautiful, but at the end, if an economy is not thriving, people don't migrate to that place, right? So very simple, unless we don't create a healthy economy, you will not be able to create a healthy game, healthy project, whatever. And that's when I got more deeper into it. In that whole process.
Okay, Siddharth, just we're gonna it's difficult for people to follow really long threads of consciousness. I know that some of our speakers have been speaking quite long.
I have 3 points there. I think that'll be something that is more valuable. So in this process, we built something called as tokenomics. We are trying to make it an open source economic model. It follows, 4 very important principles. One part is liquidity, right? In any NFT or games, it's difficult to understand whether an asset should be rare or should be more fungible or non-fungible. So we follow a economic model called as Maslow's law of hierarchy. So what does that define is at the bottom, you have something called as a need-based economy, which everybody needs, right? In the real world, everybody needs water, food, everything. That's a need-based economy. And within games, it's like the basic utility of the assets, which basically creates, more supply in the assets, which everybody needs to play. And second is the want-based economy. It's like in the real world, it's good to have a house, good to have a car, you can still survive without it. And similarly, in the game, we survive. Okay, the supply has to be a little less, and this sort of fills that bracket. And later comes the achievement-based economy. Achievement-based economy is like, hey, I don't want just a car. I want a Lamborghini. I don't want just a house. I want a mansion. Right? This is a real-based economy. And similarly, within the games, that's where the rarity assets comes in. You cannot build an entire game or economy only on 10,000 assets, right? That means only 10,000 users can play. You need to build an economy that can scale, but also have the rarity for people who want to be special. So we started building onto that and building a better fungible spectrum of how to build a game assets. And then obviously predictable supply. Famously, I think we spoke about Axie. Axie had SLP, which had a very unlimited emission. So how do you control these emissions? Creating a deflationary protocol, something like which Bitcoin and Ethereum has already done that. And how do you bring that within the game using maths, such that everything is transparent? So any market maker, any traders who are trading onto it, there's a very good predictable supply in terms of how this goes. And third very important part is the service economy. Service economy is very simple. It's very relatable in the real world. Not everybody has to build a factory or own a factory, right? Somebody has capital but don't have the time, and you can easily employ people who can build stuff for you. And similarly, in the gaming world, how do you build an economy where you build a service economy where you can easily delegate your account to people who will play for you, and you have a revenue share or a fixed income coming in. And last but not least, the governance part. Coming all this together, we were applying to the game, and these games have not actually gone down. They are more sustainable. Their assets probably would have gone down by a few percentage here and there, 30-40%, but not really bad. And we are learning from that, trying to give this information and this framework to a larger crowd so that they can adopt and build more sustainable games around it.
Thanks, Siddharth. That's really, really nice to hear, like a full kind of holistic, checklist, if you want, of like how you and your team view, what it takes to create a sustainable economy. There was a lot in there, but thanks very much for preparing those points. I'm gonna move to the next speaker because I just want to keep the conversation flowing. Arjun, if you're there, just unmute yourself. Very, very, very short, like briefly tell us who you are, and then also, what do you think is missing so far from the discussion when it comes to token economies, creating good ones, sustainable ones? Is there anything missing yet? Arjun, okay, I don't have Arjun here. Let's go to Ashen. Ashen, if you're here, same question to you. First of all, tell us quickly who you are, and then secondly, if there's anything missing yet that you've identified that nobody else has identified that is necessary for a good token economy.
Yeah, thank you so much for having me. So I'm Lucas. I'm the co-founder of Ashen Horizon. We're building a turn-based RPG. And I guess what's important for this discussion is obviously I've designed the whole tokenomics model for our game, and work as a research analyst as well, with tokenomics kind of being my favorite subject. And I think it's like most of the stuff has been covered, a lot has been said here, but what I would like to add, what I think hasn't been emphasized enough maybe, is that there really needs to be mechanisms in place that the usage of whatever the product you're building really translates into token price. And that was a big thing when we designed our tokenomics. We're like, how can we make sure that the more people are using the game, the more people are trading those assets in the game, are buying new character skins, whatever, that all this performance, all of that translates into performance of the token, that all of that is reflected in the price of the token. And I think that's like challenge evolution stage 1, which a lot of projects are already failing. And once you realize that and implement it, you kind of get to step number 2, which is a huge challenge as well, because if you do that, if that usage translates into token price, well, you're most likely going to be classified as a security in the United States, at least. So this is another huge challenge that we face with tokenomics, that there is kind of this dilemma situation that if you want to create good tokenomics, you might get regulatory issues, and if you don't, well, then your product is not going to be sustainable. We're lucky that as a company that's based in Switzerland, we don't have this issue, because Switzerland's tokenomics or token regulations and crypto regulations are much more advanced and much more crypto friendly than in the US. But yeah, I think the biggest issue is what we are missing with tokenomics in the space is actually capturing the value that the protocols create and translating that into token price.
Okay, it's a huge point, and thanks for being so specific about that. I think Kyle talked a lot about that in the introduction. Can you speak about how you've managed to capture, in your use case, how you've managed to capture that value and make sure that value stays in the economy and goes towards the token? Good, well understood about the the compliance challenges, the SEC, and securities risks. Maybe we can circle back to that, because Kyle also mentioned that as well. Like, how can we address both those points at the same time, I suppose the question is. But just specifically with what you're working on, how did you manage to capture all that value towards the token?
I think the issue that we had, or the solution that we had, is pretty simple. It's like literally 100% of the revenue that the game creates leads to a token burn. So the full revenue in the end gets shared in an indirect way with the token holders. And that's also a possibility that, at least under Swiss regulation, your token is not classified as a security token. So you can kind of, with that way, as distributing it indirectly through that mechanism, we could solve both issues at the same time. And then the next challenge is, well, okay, cool, but if you basically distribute all the revenues that your product creates, how is the business going to sustain? Because obviously as a game developer, you also need to constantly drop new content, keep the game exciting and work on it. And the people that work on that, well, they have salaries and you need to pay those. And the way we solve that is just that we allocate a fixed portion of the inflation to the company itself. And as this is a fixed token number, the actual dollar value that we get is depending on the token price as well. So we are sitting in the same boat as our investors, as well as the token holders. Like if the game is not performing well, if the players are not playing, the company is not performing financially well as well. And if we are successful, if we bring success to our investors and to our token holders, then, well, the company will also be successful. So we kind of align the incentives or align the interests very well with the people that are backing us.
Nice. Okay, thanks so much for that. It's really interesting. It's quite not radical, maybe is is too radical of a word, but it's definitely quite affirmative, I suppose, in terms of tokenomics designs. Is there anybody on the panel who hasn't spoken yet that wants to pick up on that thread and pick up with, like if they believe that's a good system, or if they have something similar or want to challenge something that's been said? Anybody who hasn't spoken yet, please feel free to unmute and come in.
Hi guys.
Yeah, go ahead there, Task on.
Yeah. I actually, what Carl said at the beginning about misaligned interests, totally agree about that. John and Siddharth both hit the nail on the head as well when they talked about liquidity, utility, and creating a sustainable economy that can scale. Lucas as well with the regulatory issues. Totally agree. Everyone kind of touched on those points. But what I kind of think is, obviously we've partnered with over 2,000 projects at the moment, and more come onto our platform every single day. But we see some projects, they have poor planning and lack of utility when undergoing their tokenomics. So they don't thoroughly plan the role of the tokens within their ecosystem or their project. And you can see that they don't really have a utility or purpose until further down on the roadmap. So they aren't really clear to their community or kind of transparent as well. So these tokens don't really serve a fundamental function right at the moment, or any tokenomics like in the future as well. It actually relies on speculation, where it's actually quite a problem at that. So the speculation can actually kind of actually crash the token price, and it doesn't really build real value for the project, as hype. It relies on hype, and once that hype dies down, this can obviously lead to confidence in the project dying down, or even the community can even abandon that project. And we believe that a community is kind of the king of the project, right? If your community can kill or make your kind of project a success, it's kind of it kind of do or die for you as well with regards to your community, and kind of being transparent and allowing your community to kind of play a role within your tokenomic structure. Like you need to understand that you need to communicate the progress, financial status, and important information to your community, especially by building trust and contribute, obviously, to the long-term project's tokenomic sustainability.
Thanks so much for that. So yeah, I mean, essentially what you're saying is you've come across a lot of examples of tokenomics, but the biggest issue is that if they're not really planning in their model, what the utility is, then either now or down the line, they're sort of walking into trouble immediately, and that seems pretty fundamental. So I'm going to ask the next speaker to come in. K Metz, if you're there, just please unmute. So far, you can pick up on any of the threads, things that are necessary for good token economies. what are red flags that you would pick up with regards to looking at a new economy model or design whenever you decide if it's strong or not or likely to succeed. Utility seems to be the most obvious one. Value capture has come in. It's a red thread here in what we're discussing. What would you like to add from here? And I've got two more coming in, Dollar King and then Jordan. I'll bring you in just after K-Metz. Okay, so go ahead, K-Metz.
Howdy, everybody. Happy to be here. My name's K-Metz. I'm a core contributor at Aladdin DAO. We are a DeFi DAO in the Curve finance ecosystem with a couple of products, Concentrator, Clever, and Protocol FX. All of those are utilized within the Curve finance ecosystem. And I'd like to talk about probably what I think in DeFi is the most sustainable model for tokenomics, and that is Curve Finance themselves with their vote escrowed model. And the entire incentive structure for DeFi basically has to revolve around creating extremely deep and pervasive liquidity within markets. And so I know someone mentioned that the most important aspect of tokenomics was making sure that the token price, all usage goes to the token price. In DeFi, actually, all tokens usage needs to go to creating exceptionally deep liquidity, and then the token price sort of takes care of itself. And essentially, how Curve does that is by taking their own governance tokens, and you lock them back into the protocol. And by doing so, you can then direct the emissions of the tokens towards various liquidity pools. This creates a very circular incentive structure that's colloquially known as the flywheel. And essentially, it's probably the most copied tokenomics incentive structure in all of DeFi. It's vastly superior to any ones that just have a governance token just to have one that might accrue some revenue. The distribution of the tokens is very important in terms of making sure that all participants that utilize the tokens are incentivized. So Curve does that very well. And so I think that's probably, if anyone is looking towards DeFi and trying to sort of understand the most important aspect of it, it's creating a tokenomic structure that does everything possible to incentivize all parties to increase liquidity on any sort of platform that you may be interacting with.
So it's about scale, essentially, is what you're saying to a large extent.
Yes, essentially making sure that your token is utilized in a lot of different places, in a lot of different ways, in a very large amount.
Okay, those are pretty easy fundamentals to get behind, to be honest. If you're doing things at scale and you're doing lots of things to create value, then I think you're probably onto something. Thanks for that. It's a big statement you've made, and also Kyle made a big statement earlier in terms of what he believes the best token economy design is so far. You're specific to DeFi, so you said Curve Finance is the benchmark. I've got Dollar King here with your hand up, so I'm going to invite you in to just pick up on that thread. And also, Jordan, you're coming in straight after Dollar King. Go ahead. Dollar King.
Yeah, can you hear me?
Yep.
Amazing. So yeah, good afternoon, everybody. Right, Dollar King, and I'm a DeFi researcher, an educator, and an advisor in all of decentralized finance. So concerning tokenomics, what I would say, concerning this is that what makes most protocol and blockchain what they are today is because of their utility. One thing about protocol is that once you have a very substantial utility, not just any utility, solving a particular problem, then trust me, your project, your protocol, or your blockchain is going to scale higher. Now, let me give you an example. Most ecosystem or most projects in all decentralized finance just come in, create cash grabs, come in, create sponsonomics, and they zoom off because they don't have a substantial utility, backing their project, right? Now, what makes Solidly, Curve, Aave, Uniswap what they are today is because of how they incentivize their community, how they build their structure, how their tokenomics is being, created. That boils down to, deflationary token and inflationary token, because that really matters in the world of decentralized finance. So when coming into the ecosystem, understand that community is first, utility is second, marketing, then how you incentivize. Now, let me give an instance. And the country created, solidly. And because of that creation, every other project fucking that particular thing are actually going high. Now, this boils down to ZK Sync. ZK Sync, came out like last 4 months. They are mainnet last 5 months. I saw ZK Sync at, $3-4 million. And there's a project that came up, Velocorp. It was at 200K market cap, but then it was a fork of what? Solidly. What made that project move from 200 to over $20 million is because of their utility. And let me just give you a brief overview of how Solidly works, right? Now, let's just imagine you have like ETH, Ethereum. You can actually stake your Ethereum to, get their governance token, depending on, the ecosystem or the dApp you're using. Right? When you get your governance token, you can stake your governance token to get, their voted escrow token, right? After getting that, you can actually vote that particular token to get more incentive. So automatically, you are making profits from your profits, and from your profits. So with that, it is very, very easy for investors to hold that particular, project or token for a substantial amount of time because of the utility backing that thing up. I don't know if you feel me. So one thing about tokenomics is when you are coming into the ecosystem, understand what you are building, know the problem you are solving, understand the utility you're actually bringing into the ecosystem. Another example is what GMX. GMX is one of the best, leverage trading platform in DeFi. And what made GMX great, right, is because of their utility. Now, SEX, centralized exchange, right, is having issues with SEX. Most centralized exchange are usually going down, and most are crashing, most are having issues. Currently, Binance is actually having issues with SEC, right? But then most investors want to trade, but they don't trust centralized exchange. So what do? They have to go down to what? Decentralized exchange to trade a token. Now, GMX is actually solving that particular problem, which brings about what? Utility. And after those utilities, they can actually, structure out a proper tokenomics model to make that project great. There are times that you don't really need to market your project if you have a problem that you are solving. If you have a very substantial project. Sorry, are you saying something?
No, I was just going to agree with you. Sorry, I thought you were finished. Go ahead.
No, I'll be done in the next 3 minutes. Sorry for the time. Sorry for wasting so much time, right? So now
you're not wasting time. You're making great points. Just wrap it up soon if you could. Thanks.
Okay, thanks. So now, concerning what I was saying, what makes GMX good is because of the way they incentivize people. So what I would say is, if you are coming into the ecosystem, know that yes, there is a problem. Know the problem you are solving, and knowing how to solve that problem is another thing. Do you feel me? So tokenomics is actually one of the major things you have to include in whatsoever thing you are building in all decentralized finance. Like, it really, really, really matters a lot. So thanks for having me here. I think I'll be done. I think I'm done. So yeah, that's it.
Thanks, Dollar King. That was I found it great. You had something to say and you said it, and it'll really, I'm going to take away from this, just because you were so passionate. What problem are you solving? If you're not solving a problem, then you don't really have a utility. So forget about a token economy. And you gave some really strong examples, I thought anyway, of projects which are doing exactly that. And that's the first fundamental. And also the community being, front and center. So well done there. So it was Jordan next, and then I'm going to go to Emperor straight after. And then I think we're getting close to have gotten through. Forgive me if I've missed you as a speaker. Don't worry, you will get a chance to speak. I think it's great so far. I'm going to ask, that's it. Put up your hand if you haven't spoken as a speaker, or if you want to speak again, you want to come back on something, that's also fine. We'll get to you after that. So Jordan, go ahead and just tell us what we're missing so far in this discussion.
Hey, how's it going? My name's Jordan. I was ex-senior BD and growth over at NodeReal. Just to give you an idea, we did Web3 infrastructure across about 13 different blockchains. So I got a wide array of seeing a bunch of different projects, either ones that we were partnered with or even ones that we were in talks with. Tokenomics is a really interesting topic because I feel like not every single protocol or Web3 or anything building in blockchain has completely figured it out yet. But I do say that like Curve has a really interesting governance model. However, I also like to say just because something works in DeFi or it works for Curve, it may not work for another protocol or it may not work for another vertical. So tokenomics that may work well for DeFi may not work well for, say, a blockchain game. I like to say in general, I'm very bullish on the possibilities of what blockchain Web3 can bring us. But I like to look at things with a bearish lens and be very critical in terms of what's active today and like have some self-awareness about where we are as a whole industry and where we can really get to. Kind of what Dollar King was saying is like if your protocol or what you built doesn't solve a real issue or there's no sort of natural demand for it, of course, the tokenomics, no matter how great you've structured it, if there's no value generation to be captured, then you're not going to have great tokenomics and it's not going to translate to a great token price anyway. But yeah, tokenomics is very complicated given that like you have a lot of, you're trying to, build things around, because if you have great tokenomics, you're trying to build them around regulation and, okay, you want to avoid them being called to security and, given like US is pretty harsh on all that. But I am hopeful in the fact that when you look at like, let's say games, and I'm not talking about Web3 games. I'm talking about like, look at World of Warcraft, look at CSGO, look at Fortnite. These have natural demand and natural economies where people are buying skins, they're trading them, they're showing them off. And there's a natural demand for them. And you look at World of Warcraft, it's almost like that's one of the true metaverses where people are interacting in it daily and they're trading, buying, selling gold. And then sometimes it translates to actual monetary value because people are buying and selling it unofficially. It's very interesting. But I think what also goes hand in hand with tokenomics is also revenue generation. And that's very important when you're investing in a project. So just given when you go back to like Web 2 tech, not blockchain, that's the first thing that really want to say, okay, how are you going to be sustainable past the seed raise or past your pre-seed funding or once you raise your Series A, okay, what's your plan to actually generate sustainable revenue?
Oh, Jordan, we're just losing your connection. It's like really breaking up. I don't know if you moved away from your router or do you want to try again?
Can you hear me now?
Yeah, it's starting to be better. Go ahead.
Okay. I'm not sure where I left off, but I'd like to say when you look at Web 2 tech and non-blockchain companies, non-Web3, you really have to think like a lot of investors grill these startups on, okay, how are you generating revenue? How are you generating, how are you going to create this to be in a sustainable economy? How are you generating demand? How are you acquiring your customers? And I think if we really go back to basics and look at Web3 startups with that same lens, I think we'll have more successful companies and more successful protocols as a result. So that may not be directly correlated with tokenomics, but I think it works hand in hand. And that's unfortunately an issue that we have to look at is like, how can we generate revenue for the team and sustain and pay employees and contributors, but then also how do we generate that into value capture for the point. I'd like to see people on the stage see what their thoughts are on that about revenue generation along with tokenomics if we have time for it, but I'll leave it with that.
Okay. You've made some great points. I think you really built on on Dollar King as well when it comes to really drilling down on this idea of first of all you need to have something that people want, and if you don't have that, then and Fortnite and World of Warcraft, hugely compelling examples of something with a really natural demand, very, very high demand, but also at scale, huge numbers. So if you have those two things and then you can design a beautiful sustainable token economy. Still some people might mess that up by breaking some of the fundamental principles that Kyle talked about and other people have talked about. But again, doubling down on the utility point, I think that was great. And your last question, which you might have to remind me, but it was along the lines of how do you sustain the expenses of a company, I suppose, and build that into sustainable token economy, something like that?
Yep.
Yeah, that's a yes. Cool. We've got a couple more people that haven't spoken. Emperor, I'm going to invite you in to speak. Thank you for being patient. You have a question that's come out from Jordan. I don't know if you want to tackle that or if you want to give us your take on, this whole discussion, if we've missed anything in terms of what it means to create powerful, sustainable token economics in Web3. Thank you for being patient, by the way. Emperor, go ahead.
Thank you. Thanks for having me. I'm very excited about the token economic space. I think a big issue in crypto is that we put the cart ahead of the horse, and it's really crazy thinking about how we have projects that have no user base, no traction, creating economic token models that are very inflexible. And in a space like crypto, you have to be extremely flexible and adaptable. And so what these token models have created is they chained systems, protocols, projects with a specific belief of how the economy is going to play out. And also, a lot of the product has been focused on the token itself, completely ignoring the users, completely ignoring the traction, completely ignoring the product experience. That's just not going to work. And as we have seen in these bear markets, every project, doesn't matter if they're big or small, gets destroyed. And I think the big reason is because the focus has been on just taking advantage of people's naivete and also just taking advantage of their addiction to speculation. And so what we need to do is we need to move away from a token model, which is still the same thing, but away from a token model to a point system, where instead of incentivizing people with tokens and creating, like having to create a specific token model, you incentivize them with points, and then you adapt the point strategy depending on your current phase. So if your current phase right now is in gaining users, the way that you incentivize via points is going to be a lot different than if the next phase is going to be in retaining the users or collaborating with other projects. And so we need to focus mostly on what is the product that we're building, how are we supporting consumers in particular, because we need to stop fixating on crypto native users. It's a very small market, it's a very disloyal market, and it's a very speculative focused market. We need to focus on how can we onboard non-native crypto users with consumer-facing applications, build really great products with that, and have a point system integrated that is really the incentive engine to generate a lot of engagement and growth. Once that gets going, then down the line, you could start really thinking about actually airdropping and incentivizing on the token side. But if we're creating these token models with zero traction, with zero user base, you're really actually setting yourself up for failure. And that's what's kind of happening with a lot of these projects, is these projects have zero idea how to generate value off of the token. And so they're creating these Ponzi type economics that make zero sense, completely ignoring the user, and then obviously running out of investor funds. And so we have to become very realistic about who we're building for, the value that we're providing, and understanding that tokens, there is a lot of value in tokens, but we have to stop seeing them as financial instruments and start seeing them as purely incentive mechanisms, where the more I'm using an application, let's say I was using Facebook since the beginning, I'm earning a lot of points. I'm earning a lot of reputation. That is extremely valuable. The more that the protocol begins to earn value and accrue value, those points will be able to position me in a more beneficial direction. But if I'm using a product purely because I potentially might earn some tokens that might be worth something one day, it's not going to be sustainable, and it's just going to fail. So I think the bear markets make us be much more realistic, and as a space we have to evolve, because we've seen it in 2017, we've seen it in this last bull market. We're not learning, we're not growing from the experiences of the past, because everybody just wants to make a quick buck. But the people that are actually building, the people that actually care about the technology, just like we saw with the early Bitcoin users, they're the ones that are going to benefit, and they're the ones that are really going to drive the growth and innovation that we need in the space.
Yeah, there's a lot in there. Thanks for that. You've set the cat amongst the pigeons. It sounds a little bit like you're sort of along the same tracks as, airdrop rewards for, people that have used protocols for a long time, and then, they get rewarded based on how much they've used them whenever there is actually a token that's been introduced. So that system is somewhat present today, but I think you're sort of calling for a much more explicit use of that type of system, which I think is extremely interesting, because a lot of logic to what you're saying, in the sense of, guys, you're just making so many assumptions at the beginning in terms of what your product will do or your service will do, and how it will meet the market and what the market will do in response to that. Rather focus on that, get that right, and then once you have that and you understand a little bit about exactly where you sit within the ecosystem that you're operating in, then you can start to bring in tokenomics much later. And I think it's really compelling what you've said. There's a few hands up, so I'm going to go to Caliverse to come in with your thoughts, and then straight after to Kushagra. So Caliverse, yeah, tell us what you're thinking here. Caliverse, are you there? Caliverse?
Oh, Tim, yeah, I think you cut out there. Kyle, I don't know if you want to take over here, but we'll go over to Calverse, if you can hear me, or we'll jump over to Kushagra.
Hello, yeah, I can hear you.
Perfect. Yeah, feel free to take the mic away.
Hello, everyone. It's Calverse. I'm an entrepreneur and ex-founder. I started crypto in 2020, and from a year and a half, I got into crypto full time as a crypto researcher, researching protocols and analyzing crypto projects. So, what are the key principles and strategies that can be employed to create a sustainable tokenomics model? I think this is a very broad question, because building in crypto can be very wide and different. Can build a layer 2 or decentralized application or capital market. But there are some key points that I think resonate, and they're really critical for most projects to be sustainable. One thing is the equilibrium between supply and demand. So when there is high inflation, the project must make sure that there's demand drivers and utility beyond speculations. And demand drivers can be like governance, revenue share with staking, or the tokenomics, or participating in network security, or paying transaction fees, or maybe using the token as collateral, or even having the community as a utility. Second thing is, of course, security. I think this is one of the most critical things, because the performance of the application or the network reflects on the token price. So when there is a hack, this immediately reflects on the token. Another thing is deep liquidity. we all know that when there is no liquidity, tokens are much more volatile. So incentivizing liquidity or owning liquidity would be much more effective. Also, I think protocols that incorporate real yield with revenue streams are much more effective than protocols that would just give their users tokens of their emissions. So I think incorporating both is a very much more sustainable than token emissions as rewards. Another thing is very important with the governance model, which is to have safeguards to prevent any malicious governance takeover. Sometimes we don't give so much consideration to this until something bad happens. But I think this is also a critical point to consider when designing the governance model of the protocol. Solvency, I think, is a very critical thing. Sometimes maybe greed or good opportunities make us not making the right decisions when it comes to investing in algo stables. But I think, or even building such protocols, but I think building things that are fully solvent, fully backed, is much more sustainable than any mechanism that relies on human trust. And something also important, that with DeFi there's very big room for innovation. And I think before building or launching any project, financial simulation and token modeling is very helpful to do. Actually, it's really critical to see how the network would work after launch, beyond just assumptions. To make also the essential changes required to reflect sustainability and ensure network success. I think that's all we yeah. One last thing I think is also an important thing is regulations. Yeah, with current, regulation landscape globally with crypto, I think it's important for projects to I think legal and regulatory compliance is more crucial aspect of tokenomic design in Web3 projects, and projects must consider different justifications, specifically the ones that they will be launching their tokens in when it comes to launching. So yeah, we'll be happy to discuss any of the points that I've mentioned with everyone in the panel. Thank you for listening.
No, you did a great job. You gave a super concise and I suppose even comprehensive overview of I think what a lot of people would agree are the important points. Maybe you gave more emphasis on.
Is speaking now. I am not sure if I can hear you.
Kelvers, can you hear me?
Yeah, I can hear
you. Perfect. Do you mind dropping down? I'm going to add you back up. I just think it's a glitch. It might be on your end because I can hear Tim, so I'm not sure.
Okay.
Twitter Spaces is being a little buggy today, so I do apologize to all the speakers here. But no, Kelvers, really appreciate your insights. Let's get you back up in a moment so you can hear Tim. If you don't mind maybe exiting the space, then we'll bring you right back up. But I'll give it back to Tim. Yeah, let's bounce around to some of the other speakers as well.
Yeah, sure. Kushagra, if you're still with us and you hear me, unmute yourself and jump in and tell us, maybe you want to respond to some of the points that have been brought up already or add something new.
Yeah, thank you so much for having me on. I'm Kushagra, currently a VC at Artstream Capital. We invest in growth-oriented ventures across China and the US, with a focus in DeFi, NFT, and Web3 infrastructure. Tokenomics is a very, very like important topic to talk about. Here, like at our stream, we focus a lot on tokenomics, especially for early stage projects, because one thing that we look for in founders is does the founder have an idea of what kind of token design do they want to implement in the future, or how are they planning to do tokens? Because we ultimately see tokens as a form of decentralizing the network and on the protocol level. So kind of thinking about, okay, like what are the value accrual like flywheels did the founder create, and what are the kind of like incentives do people have to actually use these ecosystems? So hearing everyone talk about like all these different aspects of tokenomics, and especially some of the points that Calvers made were very, very insightful. Just one thing I wanted to specifically touch upon was I've been doing a lot of research around customer acquisition cost in Web3. So figuring out like, okay, so if, for example, a lot of the customer acquisition cost it is basically, so in Web2, customer acquisition cost is basically how much does it cost to acquire one customer, right? So if you look at Facebook, Google, Uber, they all have like a cost that they take to acquire a customer. For example, Uber pays like $10 to acquire one customer, or $40 to acquire one driver, right? So I kind of did an analysis on how much does it cost for example, a user to be acquired on Uniswap, right? And it's very expensive to acquire users on Web3 platforms, especially because they're so new. But one thing that is ultimately drives home a lot of the points that have been made here is that if you have a really strong community, a lot of these customer acquisition costs, which comes in the form of airdrops, is actually not necessary, because, and then it also helps to improve the community like overall, because when you have a community that actually cares about the product and actually uses the product and has gained value from the product, it's so much easier to start this token economy. And this is like, there's a lot of things that don't really have product market fit in this space, but those that do tend to succeed because they're actually useful. So yeah, that's kind of the point that I wanted to make. And yeah, happy to hear everyone else's thoughts.
Just before you go, because you're a specialist VC in the space, just if you could tell me, like, what would be the biggest red flag you would see for if you're looking at a token economy design in a proposal from a pitch deck point of view?
I would say it's actually not having one. So like if for example, when a company is pitching at us and they don't even like mention it in their like talk or have an idea of what it kind of looks like, that's the biggest red flag, because we know that like at a very early stage in the project, it's very hard to determine what you would actually use to determine the value of the token. But having an idea and having a design around, okay, like what are the actual value accruing flywheels that are we creating is super important. So just with the founder or whoever is pitching to us, it's just very important to have the idea and having the on the back burner that tokenomics is a very important aspect. And also one thing I will say is not every single project needs tokenomics. I think a lot of founders get that also confused, because they think that because I'm a Web3 protocol, we need to have tokenomics. I think that's a very like dangerous approach, because if the protocol doesn't necessarily require tokenomics, then why would you implement it? Because it just like destroys the value of the protocol itself. So I think you need to really take a deep look at your protocol and determine first whether it needs tokens, and second, what are the token design incentives that we're going to place within our token design. So yeah, those are the two things.
That's really cool. Thanks, Kushagra. I suppose one of the things we haven't touched upon is, what are the criteria for even knowing that you should have a token economy or a token at all within your protocol? But you're absolutely right. Some of the biggest Web3 companies don't even have a trading token and tokenomics. So I think this is a really interesting thing to pick up on. And obviously, a lot of people are using a token to monetize and exit their ventures in Web3. But ultimately, if they failed at the first hurdle and they shouldn't even have one, I suppose then that's a critical area that made up front. So maybe the next speakers want to tackle a little bit on that topic. We haven't had Kivira, Hachi, and Soshank. So any of and also Pavel. Anybody who wants to just unmute themselves who hasn't spoken yet and come in and pick up any of the threads so far. There's plenty of threads to choose from. I suppose I'm interested to know, what we're missing so far in the discussion. A lot of people are hitting the same notes. A lot of people are agreeing with each other. There's been a couple of controversial statements, like maybe you shouldn't even have a token. Second of all, another controversial statement, don't have a token at the start until you've actually figured your stuff out, until you've gotten to market with your service or your product. Make sure you have product market fit, refine that, and then start introducing a token. Until then, just have a point system, just give away points. Whoever wants to unmute themselves and just come in on those threads and just tell us what we're missing, or what would you like to add to the discussion? Go ahead.
Hi guys. Thank you very much for having me. I also just want to say at TaskOn we also don't have a token as yet. We're actually building on our utility first and actual product functionality. I think that's the most important. We do the point system as well, like EXP. But I just want to obviously say thank you to the panel and to all the speakers here and to the listeners. I have to drop off. I'm so sorry. But enjoy the rest of your day, guys. Thank you very much for having us.
Oh, thanks. That was short and sweet. I'm super interested to know if you're going to have a token in the future, but if you're leaving us, that's also go ahead.
Oh, sorry. Yeah, we will be having a token, but obviously the market isn't right now. It's still in a bear market. So once we've sorted out the functionality of our product 100%, and our roadmap is I'd say more clearer for us as well with regards to giving the actual utility to our community and making sure that there is no devalue of our token in the future. With proper tokenomics, then we will be having more favorable to actually release our token. But thank you very much, guys, and have a good day.
Thanks, TaskOn. Okay, so I've got two hands up. One is from Pavel Road, and the other one is from Soshank. So I'm going to let you just decide who wants to come in first. I'm very interested in this question that we've uncovered now, which we probably should have done at the start. Why should you have a token at all to begin with? Go ahead.
Yeah. Hello, everyone. Could you hear me well?
Yeah, I got you 5 on 5. Go ahead.
Perfect. So just a little bit intro about myself. So I'm founder of tokenomics.com. It's like consulting studio helping with token economy. And when we are working with projects that needs consulting in terms of token economy, the first question we ask is like, why do you need token? And the most common answer is like, because everyone has a token. It's like the very bad approach to start. But when we dig deeper into the project, we have our own framework to do so. So we try to understand what is the motivation and what are the reasoning to have a token. And like for 99% of the project we talk, it's like to get in best fundraising terms. Basically, current situation is that most of VCs are looking into like both deal, equity deal plus token deal, and with token warrants. So without token warrants or without token, you will receive much less valuation because you need to have like better token, better protocol economy. You need to have like much more clear model how you're receiving money back into to protocol or back to your investors, which one is not clear. So in most of cases, like projects want to have like some governance token to redistribute like value back to investors. And for investors, like much more clear strategy how to exit. Yeah. And I also wanted to add one more thing that we are missing is that we are talking mostly about designing token economy, but we are not talking much about testing token economy. So Kale said a few words about like modeling and financial modeling, and I think it's like very important scene. So I just want to ask one questions to Kyle. Is that like you said you've been designing your token economy for 1 year, and how did you personally did the testing modeling, and how much effort or like time it take to do the proper testing, and what were the results?
Oh, that's a very good question.
Yes.
Um,
So that was for me, right?
Yeah, it was
ah,
Kyle, I think. Yeah.
Yeah.
okay.
So yeah, so we built the model. I mean, so that's a really good point. There's two aspects of sustainable token economics. Like, and initially, all you can really do is model out what you think is the best, but what you really need to do is simulate the model as well. And there's many different ways that you can simulate it. There's, I think one of the coolest things being built in the space right now is also these simulators that will simulate the model drafted out by economists and the team, and then do a bunch of different simulations based on different scenarios. So, you know, in this example, we're using Commonwealth, and let's say that we have, 100,000 users in total. 50% of them are staking for maximum discount in the funds, and then you've got other ones that are staking a certain percentages and for governance and DAO. And then you have different revenue that comes in from carried fees on the funds, and you've got let's say some type of distribution, and you can look at so many different aspects, because in really complex models like Commonwealth, you have a lot of different things that are happening where the wealth token is being distributed to a lot of different things. It's stakeholders, DAO participants, going back to LP. So you've got, percentage of it going to LP to make sure the LP is nice and deep, because all the exchanges and traders like deep liquidity. It goes into a lot of different. So simulating the model is really important. We haven't done that yet, because right now there's just we've had different economists look at it and look for breaking points, or if they think something might fail. But really what you need to do is kind of plug this whole thing into some sort of simulation. And Machinations is a pretty good platform, but was specifically built for games, and it was before tokens. It was built for in-game economies, and now some people use it for token economies. But it really is a game specific platform, but they are trying to generalize it a bit more for the crypto space in at large. So we have to do simulations still, but it's not as sensitive as like a two token, let's say a two token GameFi token ecosystem. That is incredibly sensitive, because you have this token that's meant just to be earned and sold, whereas in Commonwealth, for example, you have a very clear deflationary token model. So while testing could be done and will be done as we get underway, it's not as sensitive to where things will just collapse and break, because it's really just a deflationary model, and there's no reason for anyone to be selling the wealth tokens unless they're exiting the ecosystem, right? And so if we have people exiting in mass, that of course is going to affect the price, and that's something that is pretty obvious. So I think that some token models are more complex and difficult and sensitive than others. But yeah, simulating is really, really important. Take like a layer one protocol, for example, where all of the, let's say 50% of network fees go to burning, the other 50% go to validators, and then you have some people who can stake. That's a pretty simple model, right? Commonwealth does have a more complex model, but yeah, that was a long-winded answer to just say that you need to simulate. So you need to model, think about all the different ways, and another thing too that is important for people to understand. There's a really good, if you're listening to this and you're getting educated through YouTube, which a lot of us do, make sure that you're following me on YouTube, but also there's a really good YouTube channel called Systems Innovation. And if you go to systems innovation and you go to playlists, there's 3 playlists that I recommend to everybody. Everybody at our company, Master Ventures, is required to watch these 3 playlists. And I always tell people that are starting off in the space, and even if you've been in the space for a while, but you really want to deepen your understanding of the most critical parts of blockchain and token economy. So there's 3 playlists, and you should watch them in this order. One is blockchain, and I know that a lot of you probably think that you understand it already, but it's always good to refresh, and you'll probably learn a lot that you didn't know. The second one is game theory. So that's the one that no one has talked about here yet, that from what I've heard. And game theory, if you don't know, it's just trying to understand all the different ways that a bad actor might want to, destroy the ecosystem, destroy the economy, or manipulate it for their own good in some way. This is what you saw in Luna. You saw that they didn't have the game theory played out properly to where it was possible to make an attack and take down UST. And so that could have been avoided, or at least they would have known how to kind of pack their defenses a bit deeper if they had done some simulations and understood the game theory of an attack vector. And the third video is tokenomics. Third playlist is token economics. So if you go there, Systems Innovation channel, watch the blockchain playlist, then the game theory playlist, and then the token economics playlist, and you watch those 3 playlists, and I guarantee you that even if you're just joined the space this year, you will know more than probably 98% of the people in crypto. Probably more than 99.5% of all of the retail investors and market participants. And then you'll probably know more than 98% of the actual people building the space, which is scary. But this is what I was saying earlier, is most people who come into the space post 2017 don't take the time to learn fundamentals. How many of you guys listening to this have read the Bitcoin white paper? I bet not a lot of you, but I hope that you do. And these core basic, you need to understand them in order to really nail these things down well. And also, whether you're a builder or an investor, these things are critical for you to understand.
Okay, so Shank, yeah, Kyle, I think you gave a really kind of in-depth answer and more plus. A huge tip there for anybody who's wanting to know more about, well, everything about our space essentially, but especially with regards to tokenomics. So Shank, I saw you giving some reactions to what Kyle was saying. Your hand's been up for a while. Thanks for being patient. Tell us what you're thinking.
Hey guys, firstly, great spaces, and I think a very important topic which we need to keep discussing. So in my view, I think tokens are an incredibly powerful tool, and I think a lot of time as hedge fund and as advisors, we see founders don't appreciate that, and I hope that the people who are listening here understand that how powerful this is. But I will come back to this question of how do you kind of even choose whether we need token or not, because I think that's Shagra made a very valid point there. And generally, the way the mental model which I have for thinking about token is almost visualizing it as a prism, and the way you kind of change it, the colors can change, and your protocol can accordingly modify various aspects of the token economics itself. And 3 key dimensions which generally I usually want to focus on is first is does your protocol by default need decentralization, and if yes, then how much decentralization is needed? Like that's one key question, and I think there's no right or wrong answer to this, but this is very, I would say, foundational for the founder himself. Like, how do they visualize their protocol growing? And each founder could have a different strength, that they want to keep it more centralized, they want to make it decentralized. Like, both have their pros and cons. So that's one question, and which fundamentally kind of alters your token economics. The second, I think, which point which I'll slightly agree with what Emperor was saying earlier, is that basis what your protocol is, where you are in the journey. I think, for a lack of better word, Ponzinomics are a critical part of the ecosystem. Like in Web2, for example, if you have CAC, I kind of think of that equivalent as initial token economics given to bootstrap a protocol. Just to give an example, Blur could have never outsmarted OpenSea if they didn't have a very interesting community-driven incentive program, which was in points and then eventually it led to Blur token, and they have done it really well. And the final part, the final leg of the trifecta is even if these two are there, you still need to have an economic model. You still need to have a revenue model, because the first two elements can take you to some point, but if you don't have a revenue model in place, you can get into all sorts of trouble. Even if you have a great community built, even if you are decentralizing it to a level which you are happy with, but yeah, if your protocol does not generate revenue or is not sustainable, you will eventually land into trouble, which is what is unfortunately happening in the bear market for us. So these are the three elements which we try to look upon, and I think each founder, basis what they want to build, I think can play with these levers to kind of build something which is very sustainable for their business. And again, be dynamic on these three levers. These three levers don't have to be at same point at same level at one point, and people can choose to play around. Yeah.
So I got the first one, which was about decentralization, and I got the third one about economic revenue model. The second one was about community incentives, or is that right?
Yeah. Second was about community incentives. I gave Blur as an example of that.
Yeah, perfect. Okay, thank you. That's a really interesting, useful framework for us to use in terms of understanding the fundamentals of whether or not we need a token at all. So I think that's very useful. Thanks for that, Soshank. Hachi, you've been patiently with your hand up. What do you want to add? And do you agree with everything that's being said, or do you want to set the cat amongst the pigeons and tell us we're all mad?
Hey guys, g'day. Yeah, I've been listening for a while. I was taking some notes, but I'm not sure if I'll maintain the thread as well. I gotta, I guess, see how I flow. But I'm Sol from Hatchet Pocket. I actually am a game designer. I've been working in game dev for just over a decade. My specialization is in player behavior and economy. And yeah, I kind of look at tokenomics a little bit differently. Even now, since being in Web3 for a little while and having some success with Hatchet Pocket, I work in consulting with other games coming into the space. And I find they're generally simple systems. Sometimes we tend to overcomplicate things. So usually when I'm working with, especially other companies getting into the space, I just kind of get them to take a step back. And instead of thinking about the terms, Web3, token, currency, this kind of stuff, we instead try to think about like what's the fundamental behavior that we're trying to drive. Usually the tokenomics sits at the incentive layer, and these incentives are used basically to drive certain behaviors. In that regard, games, they're essentially an experience, and kind of like many potential, sometimes just a local independent, sometimes a shared experience. And the economy is mostly a kind of meta driver to the behavior that we want inside this experience. And with, I guess, like DeFi protocols and stuff, you have a very, I want to say, you have this kind of like simple utility. You know, you're like trying to trade one thing for another. In games, you have an opportunity to kind of abstract that a little bit more. You have a lot more opportunity to generate essentially almost any experience you want. In the game world, you're kind of a god, and you can just kind of like say be, and it is. You can say like there's a river here, and now you need to cut wood and build a boat, and all of a sudden,
did anyone else lose Hachi? Yeah, okay. I think we've lost you, and you were building up to such a nice crescendo. I think what you were saying was so interesting about behaviors and how creating a game gives you sort of the role of God, because you have a blank canvas to imagine the type of behaviors that you're trying to extract from this ecosystem or this economy. It was leading somewhere, and I'm really wanted to hear where you were going with that. So let's see if we can get you back up and you can finish that train of thought. Is there anybody else on the stage who wants to come in and just sort of layer on top of what we've been discussing so far? There are a lot of threads, but I feel we've sort of done a pretty comprehensive job of looking at what drives a good token economy, why you should even potentially even consider having a token to start with, what are the fundamentals, what are the nuances, what are the different strategies you can deploy in terms of delivering your token economy, flexibility being key. There is really so much coming out from this discussion. It's an education in 90 minutes, or just more than 90 minutes for the way I'm seeing things. I don't know, Jordan, do we have Hachi coming back up, or doesn't look like it for now. But let's have Kushagra back up. Kushagra, your hand's raised. What would you like to say?
Yeah, I think a lot of great points made here. I just wanted to add for everyone listening right now. One of the things that I would highly recommend, that even if you're just like trying to invest in like these different like spaces, I would just try to see how much of the token is going to the community, how much of the token is going to investors, because at the end of the day, like the fully diluted value is super important to look at. And as an investor, you don't want to get rugged. So what I've been seeing in a lot of these projects, especially the smaller caps, is that people usually don't understand how price and fully diluted value works. So just wanted to put that out there, that it's super important to look at the project like percentage, like equity token percentages, because ultimately at the end of the day, what you're getting might not be reflective of the total diluted value within any ecosystem.
Do you want to just explain that in case anybody listening doesn't quite have the sort of the tools in their box that we would have in, who are sort of living and breathing every day
Sure.
this topic?
Yeah, I would say like there's a lot of different platforms that you can go to, but usually I don't know if you guys know, like Masari, for example, has a pretty like comprehensive overview of like the tokenomics of like a lot of these projects. Also CoinMarketCap does a great job of showing you the fully diluted value. Just looking at like, okay, how much tokens have been released, and what is the actual amount that has not been released. I mean, one of the protocols that you can look at is like the SWE network, right? The SWE network is a very controversial network. I mean, in terms of like their tokenomics and the value that is occurring there, but I don't want to get too much into that, but just looking at like CoinMarketCap, Masari are two great resources. Sometimes even in the white paper, they might have something about token design. So if you are an investor in this space, it's super important to kind of look at maybe even the Twitter if they have an account on Twitter, just to see like what type of like token that they're releasing. There's been a lot of like FUD in the space, and a lot of like really bad actors trying to steal a lot of people's money. So just trying to put that out there for everyone trying to invest and also learn more about the space.
Thanks. That's really useful. I think giving those tools to the listeners is brilliant. And I hope everybody who's been listening through the conversation today has a better understanding of what tokenomics actually means, what the importance is, and how to go about understanding whether or not a tokenomics design is strong or weak. I've definitely taken a lot from this. John, you've got your hand up. Come on in. Tell me what you're thinking.
Yeah, thanks. I mean, I don't know how much time we have left, and I may be actually wrapping up the thread, but I just wanted to kind of like, emphasize the fact that, just going back to the topic, do you even need, a tokenomics model? I just wanted to emphasize, the fact that you don't necessarily have to have, a token in place or a tokenomics structure in place to, interface or to build on Web3. And I think a good kind of example of that is because, again, Clayton, where I work, we do come from a legacy, background, and because of that, we speak to a lot of legacy builders and developers looking to into the Web3 space. And a lot of the time, the reason why they're exploring Web3 and the possibilities of building on Web3 is not necessarily because of the tokenomics, but because of what Web3 offers as a technology layer. So composability, trustless transactions, the ability to access, global liquidity, without the necessary, without the bureaucratic red tape necessarily. Of course, regulatory compliance is an important part, but again, there are less bottlenecks in terms of being able to access that global liquidity. So, just wanted to put it out there that you don't have to have because. Tokenomics to build on Web3, because I do find that a lot of builders feel like they're obligated to have a tokenomics model to build on Web3, but that is not the case, and just wanted to put that out there.
Thanks so much, John. I think it is a good way to wrap up. We're getting close to the 2-hour mark, and that's really our limit for the All Street Beat. I'm hoping that everybody has taken as much from this as I have. We set out today with the aim to understand what it means to have circular and sustainable economies. I think Kyle spelled it out brilliantly at the start in terms of what a circular economy means, the value capture. Look out for the value extraction. Is that happening? And then potentially that's maybe then not the most circular and closed loop of economies, and that's something that's going to eventually undermine sustainability and value capture and the value accruing to the owners of the protocol and the token holders. There was so much emphasis today, which I thought was brilliant, on what is utility? Is there a demand for what you're doing? First principles. Forget about tokens. Forget about token economies even. First of all, prove that you have a product market fit for what you're doing. And then, this strategy of gaining user points or XP or whatever it is, and then being rewarded with airdrops down the line with a token later. And, there's a lot of, I think, credibility behind that strategy in terms of bringing your tokenomics to the market. A lot of people who study tokenomics on a daily basis, VCs and otherwise, were talking about red flags. I thought that was super interesting. The first red flag, if someone's talking to you about their project and they don't even confront the topic of their tokenomics, they somehow try to sidestep it. Massive red flag. Carl came with a great example at the beginning of when that happened. And then community front and center, of course. If you are aiming to decentralize your protocol, then tokens are a way to do that, of course. All the regulatory pieces that come in there. There's so many things to think about, but at the same time, people are saying don't overcomplicate things. I loved what Hatchie was saying at the end, and Hatchie's back with us. I don't know if you want to finish your train of thought just before we close off. If you can, in like 20 seconds, just give us the end of what you were saying. I think we lost you when you were kind of saying that creating a game economy gives you the right almost to play like God, because you are able to decide what behaviors you're looking for. It's like a blank canvas, and then we lost you. So just give us like elevator 30 seconds.
I angered the gods with that statement. Basically, we're creating experiences. So we're trying to incentivize behavior in that experience. Most of token, I guess, like in this space, in DeFi, mostly value is kind of zero sum. In game experiences and that kind of thing, it's not really a zero sum experience anymore. And in that, we have some problems, some opportunities. I see it as mostly opportunities. And yeah, I'll keep it short and sweet. But basically, in most cases, as long as your faucets, so the places where you're emitting your token, the amount of token in the system is less than your sinks. So basically simple supply and demand. It's usually a more sustainable model. And then I think after that point, we just try to focus on which behaviors we actually want and trying to incentivize those in organic ways and pushing for those opportunities, especially opportunities that aren't around in Web 2, that are around in Web 3. Some of them we're kind of forced to look for those opportunities. For example, we have like issues with regulatory bodies try not to be a security. And in most cases, we push towards a broader ownership, essentially the DAO model. In that, there's some, I'd say, untapped potential. In Hatchie, for example, we have a decentralized IP. We generate a brand association and we tokenize the ownership of the brand. And then we basically look at all the different points of value generation and look for ways to funnel that back into the token and have the token store and represent that value. And there's a lot of systems that do something similar. But yeah, basically simple supply and demand and focusing on the experience and the behaviors we really want to incentivize. And yeah, thanks everyone for all the information, and thanks for giving me a place to speak, and hope to join in the next one.
Thanks. I'm glad we got you just at the end there. Thanks for rounding that off. You said something profound there in terms of sorry, I lost it, but I was getting to the point of we wrote a paper as well, which reflected Kyle's example of Uber and a decentralized version of Uber, and then somewhat of a semi-decentralized Uber. It's on our Medium, Commonwealth's Medium, and it's called Code is Law, but Economy is Key. It's a great paper if you want to understand a little bit more about tokenomics, just from a kind of closed loop circular economy point of view, and yeah, making sure that all that value that is extracted is then held at the by the token holders. I think that's something hugely important that we're all emphasizing here. Kyle, any last words before we go? I'm just going to invite you in, and then we're going to wrap things up in the next 30 seconds. Kyle, no, I think I've lost Kyle.
I'll get him.
Thanks, Kyle, and thanks to everybody who joined us today for the All Street Beat. I think we have achieved our mission, which was to really dive deep into tokenomics. It's not the most exciting subject for some people, but for everybody listening, thank you for staying the course. I hope you have learned something. I hope you picked up some of the frameworks and some of the tips. And some of the, I suppose, the alpha around tokenomics from these experts on the stage. Thank you so much to all the speakers. The next All Street Beat will not be on a Monday. We're changing that. So look out on our Twitter. It's going to be moving to Thursdays. The next one's going to be super exciting. We're going to discuss investment nightmares, like some problems people have run into whenever they've invested. Kyle already spoke about one today, which was phenomenal. We're going to talk about more, just so that we can learn about the pitfalls and the dangers, and then also build up our understanding of what a good investment actually looks like. So yeah, look out for that. The next All Street Beat will be coming soon. Thanks to everybody. Huge thank you to all the speakers. It was really a high-level discussion, and yeah, have a great day.